All right. What's up, everybody? What's up, traders? What's up, tycoons? Super excited for today's video. We're seeing some developments in the market, especially looking at the internals that you guys need to be aware of. It's going to be very relevant. Everyone's talking about a bearish September due to seasonality. And we're going to take a look behind the scenes and see, do we have any data, that really supports that thesis? That's what we're going to look at in today's video. It's going to be really good. Be sure to smash the like button, subscribe to the channel if you guys are new, and we'll go ahead and actually get straight into it right here. We're going to head on over to our Thinkorswim platform. And the first thing we're going to take a look at here is this is going to be your percentage of stocks trading above their 50-day and their 200-day moving average. All right. So, I use this a couple ways, right? Oftentimes I'll look for divergences, right? We have the S&P 500 on top here. We see over here it's making higher highs, and we see the percentage of stocks above their 50-day moving average is making lower highs. That ended up leading to a drop over here. We see the percentage of stocks above their 50-day moving average making higher highs. I'm sorry, higher lows. We see the percentage of stocks above their 200-day moving average making higher lows. Meanwhile, the S&P was making lower lows. That's a divergence, and we see it follows through. But what I'm seeing right now, what I'm paying attention to is the percentage of stocks above their 200-day moving average is at 51% right now, right? This line in the middle is 50%. We need to see this above 50% for the market to go bullish. If this rolls over and this starts to trade below and it continues to go below 50%, that's going to be a bearish signal, right? When you take a look at a little bit of the breadth of the market and some of the internals, we see that the percentage of stocks trading above their 50-day moving average is already well below and actually took a nosedive today. So, if this develops, over the coming week and weeks, and this starts to trade below, that's going to be a bearish signal for the S&P 500 and help support that bearish, type of seasonality pattern. Now, what are some other things that I like to look at? Okay, well, we can come in here and we can take a look at our four pillars. All right. I've talked about the four pillars a few times and, kind of broken down what they are. But essentially what we're going to look at is tech. Okay. We have tech on the top left. We have the semiconductors right here on the top right. Then we have home builders here on the bottom right. And then we have the industrial sector XLI here on the bottom left. And I talked about how, to see strength in the market, okay, these are the four pillars, right? So you need to see all four of them performing well to see the market really continue to go higher. Now, tech did pretty well today, right? I mean, it didn't do anything amazing, but you can see it's green here, it's green here. These are some weekly time frames. If we go down to the daily real quick, before we do that, I just want to highlight, basically all of these are stuck in overhead supply. Okay. And we're really not going to see the S&P 500 make new highs until we break through this overhead supply on the tech sector, right? We can see, overhead supply here, on the semiconductor space as well. We can see here, right? Stuck in this overhead supply. On the home builders, we can see overhead supply, stuck, battling that overhead supply. And same here on the industrials. We really put in new highs, and this is more of the overhead supply here. But until these break out to the upside and make new highs, that's when the S&P is actually going to follow through and make some new highs. Now, when we zoom down to, like the daily time frame for this, okay, we can see a little bit clearer, the performance, right? We saw that semiconductors did pretty well today, up 0.24%. Again, nothing crazy to write home about, but still positive on the day. These are nice daily candlesticks. But when you take a look at industrials, look at the huge red candle today in industrials, right? This is why we're seeing the S&P 500 down. It's because we did not get any follow through in the industrials. And that's what we talked about in last week's video when I broke down the four pillars for you guys. I said that industrials were lagging. If we want to see the market rally higher, we're going to need to see some follow through from the industrials. Now, is the market shifting to defensive, right? Maybe that's a case that we could make at the moment. And so this is a metric that I like to use to see, is the market going defensive, right? So we have the S&P 500 here on top. We've got the S&P, this is high beta stocks versus low volatility stocks right here in blue. Then in orange, we've got consumer discretionaries versus consumer staples. And then this purple line here is HYG and IEI. This is kind of a way of measuring credit spreads. And then at the bottom here, we have XBI. This is your biotech sector. Now, the reason that I label this and use this to measure if the market's going defensive, because high beta stocks, obviously, when this is going up, this is basically risk on in the market, right? The market's going risk on, and so when you see this chart going up, this means that high beta stocks are outperforming low volatility stocks, and when you see this start to go down, oftentimes it can be, a topping indicator for the market a little bit before, right? And when this goes down, it means low volatility stocks are outperforming high beta stocks. You see, eventually the market ended up falling afterwards and going in a downtrend. You can see it topped out here as well, and then the market went in a small downtrend. This is the consumer staples or consumer discretionary divided by consumer staples. And really, this is the area that's looking good. Everything else here is kind of screaming risk off a little bit, right? When we take a look at the high beta to low volatility, it inched higher today, but we didn't really see, upwards momentum, right? It just inched higher. If this starts to roll over to the downside, that can coincide with downside in the S&P 500. Discretionaries outperformed staples today. But if this starts to roll over, then that could coincide, with and lead and be a signal to some downside potential in the S&P 500. When we take a look at the credit spreads right here, we see that that went down as well today. Right. And so when you see this happening, this pretty much always happens every time that the S&P gets a drop, right? And we talked about most recently how this wasn't really dropping and there was a divergence. We saw how, this was continuing to go higher here, right? Making higher highs. Meanwhile, the S&P was actually making these lower highs and lower lows at the moment. And that was a slight divergence. And that was an indicator that, hey, maybe this pullback is just nothing more than a healthy correction. We're not seeing this chart go down. And sure enough, we did end up start to rally afterwards after that. So we really need to see some follow through, right? If you're a bull, you really need to see high beta stocks really, continue to outperform relative to the low volatility stocks. We need to see consumer discretionary stocks continue to outperform relative to consumer staples. Okay. And we need some follow through here from the biotech sector. The biotech was red today, right? Biotech went down. All right. Biotech is arguably the most risk on asset class in the market. And we can see that that pulled back today. So we're seeing, pullback in, the XBI and the biotech sector. We're seeing a pullback here on our chart we use to measure credit spreads. We're seeing a slight uptick in the consumer discretionary to staples and a slight uptick right here in the, high beta to low volatility. But we didn't see a lot of strength in these two, right? Both of these just kind of inching a little bit higher. If these start to roll over here this week, that could spell more downside potential for the future. So, really we got basically a 2 out of 4 of these were positive, but we didn't see lots of strength in the ones that were positive. So, just a quick guide to the market right now and some of the things that I'm looking at. Hopefully you guys enjoyed this video. If you did, smash that like button to subscribe to the channel if you guys are new. I also put out a completely free newsletter for you guys. If you guys are fans of trade ideas and overall just fans of investment intelligence and really good market information, whether it comes to strategies, whether it comes to, just general knowledge that you guys want to have that maybe you never heard before, you're definitely going to want to subscribe. All right. There's a link in the description and in the comment section down below. It's a really great way to help support me in the channel, while also, helping yourself out and coming in there and giving yourself some really good, valuable information. Oftentimes that I'm not really going over on YouTube. Most of the time, this is going to be unique data that I'm putting out in here. So that way I'm not repetitively, just putting out and saying the same thing all the time.